What drives a real estate investment trust to shell out $785 million on a shopping hub? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. The recent acquisition of Legacy West's retail portion in Plano, Texas, has raised eyebrows in the commercial real estate sector. This high-profile purchase was made by Kite Realty, based in Indianapolis, in partnership with the sovereign wealth fund GIC. Together, they acquired the retail component for a staggering $785 million, including debt. This transaction underscores the ongoing appeal of premium retail spaces, even as the industry grapples with shifting consumer behaviors and economic uncertainties. Legacy West has become a vibrant shopping destination, attracting not just local shoppers but also visitors from across the region. The acquisition by Kite Realty and GIC highlights a strategic move to capitalize on the retail sector's potential for high returns, particularly in well-established and high-traffic locations like Plano. This investment aligns with broader trends in commercial real estate, where investors are keen on assets that promise resilience and long-term growth. For those of us in Ontario, particularly in areas like Kitchener-Waterloo, London, and Cambridge, this acquisition offers insights into how cross-border investments can influence local markets. While we may not have a direct equivalent to Legacy West, the principles of investing in high-demand retail locations apply universally. Canadian investors can draw parallels in their strategies, especially in thriving urban centers, where retail spaces remain a cornerstone of commercial real estate portfolios. In the United States, the acquisition of Legacy West represents a significant commitment to retail real estate, a sector that has faced its share of challenges. However, with unique shopping experiences and strategic locations, retail properties continue to draw substantial interest from investors. This trend is mirrored in Canada, where similar investments in commercial properties are seen as opportunities for robust returns. In a notable development for the Wake Forest area, a Baltimore-based developer has initiated the construction of a significant 30-acre business park. The ambitious project, as reported by Kaylee Thompson of the Triangle Business Journal, is set to include a mix of retail outlets, dining establishments, office spaces, and industrial facilities. This mixed-use business park is expected to create hundreds of jobs, driving economic growth in the region and providing a considerable boost to the local real estate market. The introduction of such a large-scale development highlights the increasing demand for versatile commercial spaces that cater to a variety of business needs. With the inclusion of both industrial and office spaces, this project stands to attract a diverse range of tenants, from small businesses to larger corporations, seeking a strategic location in North Carolina. For those of us observing from Kitchener-Waterloo, London, and Cambridge, Ontario, this development illustrates a trend that could well be mirrored in our own markets. The integration of retail, office, and industrial spaces into a single development is a concept that resonates with the needs of modern businesses looking for flexibility and convenience. As our local markets continue to grow, similar opportunities might arise, offering potential for cross-border investment. In the United States, the Wake Forest Business Park reflects a broader trend of mixed-use developments that are becoming increasingly popular. These projects not only serve to meet the demand for diverse commercial spaces, but also foster community engagement and economic vitality. Such developments offer valuable insights for Canadian investors considering similar ventures, particularly in growing urban areas where the demand for multifaceted commercial real estate is on the rise. Our final topic today focuses on the growing trend of environmental, social, and governance, or ESG, investments in commercial real estate. A recent survey conducted by Knight Frank involving 40 investors sheds light on the factors driving this shift. The survey reveals that net zero targets and the promise of higher returns are key motivators for investors prioritizing ESG investments in the commercial property sector. The focus on ESG criteria is reshaping investment strategies as stakeholders recognize the long-term value of sustainable and responsible investing. This trend is not confined to one region, it's a global movement, with implications for how real estate portfolios are managed and developed. For Canadian investors, particularly those in Kitchener-Waterloo, London, and Cambridge, Ontario, the emphasis on ESG factors presents an opportunity to align with international standards while potentially enhancing property values. As the demand for sustainable buildings and practices grows, so does the potential for competitive advantage in the marketplace. Across the border in the United States, the push for ESG compliance is equally robust. Investors are increasingly looking at the environmental and social impact of their portfolios, recognizing that properties adhering to these standards not only contribute to a healthier planet, but also attract tenants who prioritize sustainability. The Knight Frank survey underscores a broader understanding that ESG investments are not just about being responsible corporate citizens. They also represent a strategic approach to risk management and value creation. By incorporating ESG principles, investors can mitigate risks associated with regulatory changes and shifting consumer preferences, while positioning themselves for long-term success. As we conclude today's episode, it's clear that ESG considerations are becoming an integral part of commercial real estate investment strategies. Whether you're in Canada or the United States, the focus on sustainability and higher returns is shaping the future of the industry. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.